non-financial services things, including spending 2 years in the Peace Corps. So let's go into the content of today, which is why is cost improvement important? And I want to take a step back and think about what are we really accomplishing with a fintech in the United States by first looking at what are the incumbents doing, okay? And how do banks actually, what's the business model for a traditional bank, okay? And let's look at a First Hawaiian Bank, a very traditional consumer-oriented bank in the United States. The starting point of a bank's job is they are accepting deposits from everyday adults, right? And these are people who are earning money through their jobs or any other way, and they don't want to hide this in cash under their mattress. They need a safe, secure place that facilitates their spending of their money, but then also lets them save it, perhaps in a savings account where they earn a little bit of yield. And so it's a pretty basic set of needs, and they go ahead and deposit that money in this bank to hold on their behalf. It is not the bank's money; it's actually a liability for the bank, but the bank is happy to do it. And why is one of the main reasons a bank is happy to do it? Because they redeploy that capital. Okay, they don't charge much for actually holding the deposit. Instead, they are making use of that capital by lending it out to someone who wants to buy a home, to someone who wants to buy a car, or maybe a business that's expanding, right? And let's take this real example of First Hawaiian Bank, and the numbers will show you how this actually plays out. So First Hawaiian Bank is a public company, so you can look at their financials. And you see in their balance sheet, according to Q2 of 2023, they held $21.1 billion of deposits. That's how much different households have deposited into that bank as a snapshot in time. And then in turn, they've lent out at that point in time $14.4 billion of loans. Okay, that's not new loans. That's how much is outstanding at that point of time. So that's what their balance sheet looks like. And as stands to reason, the amount they've lent out is actually less than the amount held for deposit, right? That they're holding for deposit. But it's a pretty similar number. So how is this translated to financial gain for First Hawaiian Bank? Well, if you look at the income on their deposits is a couple different fees, but about $22 million that they earned in that quarter. And that's from checking account fees, some debit card, ATM, things like that. So not a huge amount relative to really what the basis of their profitability, which is the interest income they earned from lending out that $14.4 billion. And that was $160 million. Okay. So that for them is what they're trying to, from a business standpoint, accomplish in a profitable way, and makes this bank really run, right? It's not the fees, it's really the ability to redeploy that capital. So let's look at what typical consumer-oriented U.S. fintechs, what their business model is. And a key component, we just heard a little bit about compliance. Well, a key component of the way a fintech in the United States works is we partner with a bank to provide some of the underlying services, and the fintech is the front end of acquiring the customers, servicing them, and so forth. But the deposits that a fintech may gather from their customers, right, the paychecks and savings accounts, that is not within the purview of the fintech to then go ahead and lend out those deposits. Okay, a fintech does not have a bank charter that will allow them to do that. Okay, the underlying bank could, and so let me just make this a little bit more clear. So if you look at neobanks in the United States, and here's three prominent ones: Chime, one of the largest, Cash App, the Cash App card or providers, the company I work at. The sources of revenue come from a few fees on the deposits that are being put into the accounts. That's interchange, which is a small proportion of the amount spent, ATM fees, and then there's cash load and other kind of miscellaneous fees on the deposit side. But there is nothing on the lending side. They cannot redeploy that capital for lending. Some, I have an asterisk here because there's some lending programs, but usually it's sort of special programs. They're not actually using the deposit balances to then go ahead and redeploy in the form of a loan. The other main kind of consumer-oriented fintech in the United States are these lenders, right? You have a company, Affirm, which is really prominent as a point-of-sale lender. Prosper, a company that I used to work at, which is unsecured installment loans. Upstart, another large public fintech. On the deposit side, they, for the most part, have no deposits, right? They are not collecting deposits from customers, but they are doing lending, right? And so they do get that side of, similar to banks, that net interest margin on the loans they put out. But the source of capital for these companies, they actually have to borrow the money from banks, basically, in order to have the capital to then lend out to their borrowers. So that is a little, in some ways, less efficient from a revenue perspective as compared to what a bank can do. So this is a challenge for fintechs in general, and especially in 2023, 2022, this is becoming more and more evident. But there are a few advantages that fintechs need to deploy to basically exceed and beat out the incumbent banks. And two angles that fintechs particularly have an edge on: one has to do with technology, and two has to do with the team and the dynamism within these more entrepreneurial companies. And there's two areas of focus where they can really differentiate themselves. The first is the cost to acquire a customer. This is the marketing, the relatability of the brand, building unique product features that banks do not have, and that pull in or attract new types of customers, maybe coming from also new generations or new groups that banks traditionally did not target. Okay, for fintech to succeed, they need to do very well with cost to acquire and have an efficient marketing funnel. I am not a marketing person. I'm not going to give advice on how to do this. And it's not something we're going to talk about today. But as an ops person, we're going to talk about the other component, which is the cost to service. How much cost does the fintech incur for each incremental customer, right? And that, again, with using technology and other strategies, you can turn your fintech to be a winner in the marketplace. Okay, so how to do that? I'm going to talk through three general tactics. This is not exhaustive. It's a little bit more giving you all a flavor of approaches, and there's a lot more detail that would go into actually executing these. But it gives a sense, right? Planting the seeds of how, as an ops leader, you should go ahead and do that. One is you have to start with insight and understanding the unit economics. I'll talk a little bit more what that means. Two is how to use technology to address the root causes of the costs, right? And number three is working with your vendors and managing that expense. Okay. So let's talk about the getting a baseline understanding of your unit economics. Without understanding, okay, your incremental cost per customer, it's going to be hard to manage those costs. Okay, and there's three considerations I would throw out, and how do you paint this picture? First, you need to identify as a company which of your costs are variable costs and which are fixed costs, because the focus needs to be on the variable costs. The difference is between a fixed cost and a variable cost. A fixed cost are organizational and research and development costs that don't necessarily have to increase as your customer base scales. Okay. Your HR department, your engineering department, your legal department. If a company adds 1,000 more customers, the company does not need to hire another lawyer or another engineer necessarily, right? But it does need to hire another customer support agent. It does need to pay more to their ATM network because some of those 1,000 customers are going to use that ATM network. So those are the variable costs that really foretell the scalability, the economic feasibility of your company. Two, this is this is a messy accounting picture initially. There's a lot of invoices, the way vendors charge, and it's not clear what are the variable costs versus the kind of upfront costs. You have to think about how do you break out your customer support costs into unit levels. But eventually, through starting with the big picture and then aggregating that, you then want to allocate that to your customer segments, right? And just to keep it simple, what do I mean by that? Let's just say there's two customer segments. You have your active customers and your inactive customers, right? Your inactive customers might be ones who signed up for your bank account but never did a deposit, and they're just sitting dormant as accounts. Well, you still incur some costs with those inactive customers. So of all of those, let's say your payment processor charges a little bit for maintaining that account. Maybe you need to send out bank statements, so there's some small cost there. So there's some small costs for that. But then you allocate for your active customers a lot of other costs. And just to show here, for example, maybe your ATM costs are going to be really concentrated in your active customers, or any disputes, Regi disputes that those customers incur, right? And so you want to come down to an average number for that bucket of customers. And then second, you really want to manage that number. So how do you do that? Well, one approach is you can establish goals for each of these per customer costs. Right? So maybe let's just take your payment processor cost. Maybe that costs right now about $3 per customer today. How do you get that down to $2.75, right? Or your card network. How do you shave off 15, 20 cents there? And furthermore, depending on how your organization is set up, a good approach is to assign accountability to specific functions in your company. Assign engineering to focus on, let's say, the payment processor costs and bring that down by 20%. Maybe assign your risk team to bring down the dispute processing costs by 30%, whatever it is. And those drive the company objectives, right? And the ideas for what the company should work on over the course of the next 6 months in order to, again, create a sustainable and profitable business, right? A lot of, frankly, these functions embrace the opportunity to take on this challenge. So it becomes a very kind of engaging and fun exercise. All right, so if you are one of those teams, let's say you're the engineering team, how do you start thinking about reducing costs? Where do you even start? Well, taking a subset of activity, okay, that leads to a cost, you want to look for a root cause solution. So what do I mean? Let's just say one of the activities that incurs cost for your company is a payment gets declined, right? The customer attempted to purchase a $20 item and they only have $10 in their account. So that led to a decline of the transaction. There may very well be two costs that happen to the company. The customer does not pay you for those items. The one, your payment processor may charge you a small fee, depending on your contract structure, on declines, right? Maybe it's 2 cents for each decline. And then the network, Visa or MasterCard or whoever, will also charge you a very small fee, a penny or two, for that decline. But at large scale, those numbers do add up. So what, as an engineering team, can you do to prevent that cost? And I'm just giving you a fictitious example here, so don't take this too seriously that this is an overnight solution. But maybe the engineering team says, okay, what about building an internal layer of authorization decision, right? That can prevent these transactions from even going to the payment processor and Visa. So, for example, the payment gets denied by an internal decision engine, knowing the customer's balance is insufficient. And as a result, the authorization request never gets sent to the payment processor and it never gets sent to Visa, right? And therefore, instead of it being a 4 cents cost, there's 0. Now, this is just one example. The point is to move upstream from an activity to find what prevents that activity from being a costly one, right? Just to give another example here, you could imagine this applying in any customer contact to your customer support team, right? Customer calls to support, calls your team to change their address, right? Their mailing address. Maybe they ordered a new debit card and they want it to the new address. Each call takes time of the agent and maybe some software. And in general, that could easily be a $2 or $3 cost, okay? You can imagine a bunch of things that engineers could do so the customer never had to make that phone call in the first place. I'm going to leave it to you to think about the various options there, but it could be a better app service, a form on the website, what have you, and push the customers towards that lower cost option, assuming again that it still keeps the customer satisfied, and then they do that other option instead, and you have whatever new cost structure is in place there, right? The point is get to the root causes of the activity and build solutions there, and in the long term, you have a different cost structure than where you're starting. Third, vendors, okay? And we sticking with the US Open tennis theme here, we have a frustrated, overwhelmed player looking at all these various third-party vendors that a neobank or a lending company could purchase, right? And the truth of the matter is that fintech companies are dependent on vendors. None of them, and banks for that matter, build their entire stack themselves, right? It doesn't make sense. So it is part of building a fintech company is selecting vendors. However, there are a lot of vendors, and for a lot of folks, you will be sold a variety of services. And rather than buying what you are being sold, it's important as a leader in an organization to identify what you need and buy that, right? Don't just buy what is being put forward in front of you. There are services that will be put in front of you that might help prevent fraud or that might make your customer service team more efficient. But that service, that third-party vendor, actually costs more than the amount you are saving from their product, right? And that's the type of evaluation I encourage leaders at Fintechs to do. How do you do that evaluation? Don't do the thing on the left, right? Don't be a little kid throwing money out the window because the product seemed cool. As you're going through a vendor selection process, you should get price quotes from multiple options, okay? And you should test those options. And if the product quality and the fit of that vendor, right? Let's just say it's a fraud vendor. If off the bat you could tell it's not a good product quality, such as vendor D in this made up example, then don't worry about their price. They're out of contention, right? They're not in the competition. But once you have 2-3 vendors, now you should look at the cost comparison. And they sometimes will explain their costs or structure their costs in different ways, their pricing. So you have to boil it down to a common denominator, such as the monthly cost per customer for that vendor service. And then you see what is the lowest vendor. And frankly, you don't stop there. You let vendor A and B know, A and C in this case, what more or less what costs they need to beat in order to win your business, right? And so as a fintech, as a buyer of vendor services, you need to create a competitive dynamic for the companies that are selling you services. And that's the way you end up in a better position. So that's my experience. I will say that some companies, product quality and fit might be the only factor that really matters. And for certain high margin situations, that might be the case, right? So you still have to apply this rule for cost sensitive situations. With that, I'm just going to summarize the main points here. One, consumer fintechs it's actually quite a hard business, especially when you compare the revenue sources relative to banks. And so you need to build an edge on costs to really get ahead. And the good news is I've done that. I've worked at companies where we focused on this, and a lot of headway can be made that is quite differentiated from banks. And there's three things as starting points there. Again, create a very detailed understanding of your unit economics, build out that reporting and the accounting infrastructure so everyone in the company understands your variable costs. 2, use technology to get at the root causes of those costs. And 3, aggressively manage your vendor costs. And with that, you'll have a ton of success. Kind of like this little trick shot in the U.S. Open, or not trick shot, but kind of cool shot. So with that, I wish all of you good luck. Open to any questions, and I will stop sharing my screen here. Yes. So what are some common pitfalls to avoid when scaling a fintech company in terms of cost management? It goes in stages as a company, right? A company, kind of like a child growing up. The way you treat it in its early years is a little different than in its teenage and adult years. And in the earliest years, I would actually say the investment in cost management should probably be light, right? You're really trying in the first stages to build a product that customers like and are going to adopt. And despite what I just talked about, I would actually recommend you focus on the product market fit and the quality of your service more than costs in the first year or two that your product is being launched. And it's in the second stage where you really want to start getting into that deeper understanding of your cost and figuring out, okay, now that I go from 5,000 customers to 100,000 customers, how do I do that so I'm not making my cost go up 20 times, right? And that takes a mental shift for both your the folks at the company and the leadership to create new priorities and ask new types of questions to everyone on the team. And sometimes I think some companies wait too long to ask that question. And then they realize, we're running out of money because they didn't do it at 5,000 customers. And then some never do it. And some do it too early, where the product isn't really being adopted by customers yet. And you're managing costs and cutting things out. And at that point, you're not going to scale in the first place because customers don't like your product enough, right? So it's really finding that right point in time to say, okay, now is the time. And I think a gap to avoid or a failure mode is going too early or too late in setting that priority.
Great. Well, thank you. Thank you. And I got one more question. I will also type it in chat so that you could read it and answer it as well.
Okay. So what KPIs should consumer fintechs monitor to assess the effectiveness of their cost management strategies? Ultimately, a simple one is your average cost per customer, right? Again, take away the fixed costs. I would not include engineers, the salary of your CEO, any of that, right? But when it comes to your operations teams, anything that varies with customer, right? Think if you doubled your customer count, what other expenses would double? So those costs, figure out how much that is per customer, right? And that's the key KPI to manage down. And if, as an investor in a fintech, I would hone in on that particular variable because that speaks to the potential of your company, okay? If your variable costs are higher than your variable revenue, then why would I invest in your company? Because that just means you're going to lose more money.
True.
But if each incremental customer is bringing in more revenue than cost, well, then there's a business there worth scaling, right? And worth investing in. So ultimately, it's knowing your variable revenue and your variable costs. That's the single. If I had to pick one KPI, that would be it. But each company what is made up of that cost is going to be a little bit different.
This is great. This is great. Thank you so much, Mike. Thank you for the insights, and we hope to talk to you again and hear the